One day you have a bearish view on Titan stock. The market opens exactly at the resistance zone and displays a bearish candle. You think everything is set for a big fall and take a short trade, hoping you make very good profits today. But the price gives a big move on the upside. It will not only hit your stop loss but also make you look like a fool even after following all the basics in intraday trading. Another trading day, you are bullish on the same Titan stock. The market opens exactly at the resistance zone and displays a big bullish candle. You think it will definitely go upside this time and you opt for a long trade. But surprisingly, the price goes flat for the rest of the day. It tests your patience with every candle and you are exhausted by this experience by the noon. One more trading day, you are bearish on the same Titan stock. The market opens precisely at the resistance zone and displays a big bearish candle. But this time you don't have 100% conviction because of the past experiences and you think the previous day's experience might repeat once again. Because the previous day also price displayed a big bearish candle at the open, but the market was flat for the rest of the day. So you don't opt for any trade on this particular day and sit quietly. But to surprise you, the price shows a big fall and brings a lot of emotions in your mind. After facing these experiences, you feel like whatever you studied is a waste of time and you tend to think trading is just a stupid game, right? But if you are aware of these simple 6 intraday trading concepts, not only you avoid these kinds of experiences, but you also get awesome results in your intraday trading. Friends, I will explain these 6 intraday trading strategies in depth along with many examples. So please watch the video till the end before commenting your doubts or questions. My best-selling book, The Subtle Art of Intraday Trading, is republished with one of India's leading publisher, Manjul Publications. This book is not only consists of advanced intraday trading concept, but also 10 intraday trading systems that are back-tested against 10 years of historical data along with the backtesting results. If you are interested, the link is in the description. Now, let's dive into the crazy world of intraday trading. Friends, these 7 intraday trading concepts work well with all the instruments. However, they work fabulously well with good stocks because indices like Nifty and Bank Nifty often display big gap up open or big gap down open in nowadays, which is an enemy for intraday trading. Gaps are very good for BTST trading and I will cover them in another video. So the first technique is to make a note of previous day close. Do you agree that market is a tug of war between buyers and sellers? So the close of the previous day indicates who won the battle on that particular trading day, right? Whether it is bulls or it is bears. Now I will take the same Titan stock to explain this concept. This is the chart after the completion of the market on 28th March 2024. It appears like the market is bullish as the price closed above the trend line on 28th March, right? But when we get into the 15-minute time frame of the same stock on the same day, it gives a different picture. Please have a careful look at the close and the big selling candle that occurred just before the market close. So this selling candle is formed by the big players, right? Because it is a big candle of the day. And it occurred just before the close of the market. So what this indicates is that big players are not confident in carrying their long position for the next day, or Big players have built up short position, right? Friends, please note that where the big candles occurs matter a lot in trading. In this case, this big candle occurred when the price tried to break the resistance line on daily chart, right? So even if you can't develop a short view, you should not keep a bullish view for the next day until the price breaks above the high, right? So you can see what happened on the next trading day. There was a big selling candle even on the daily time frame on the next day, and the market also fell continuously after that for a few days, right? We will look at one more example. On 8th February, the price tried to break the support line, right? But look at the close. It closed exactly in the middle range of the day, right? We can see it very clearly when we get into the 50-minute time frame. This is the 50-minute chart of Titan on 8th February. Carefully look at the close. It came near the middle range of the day, right? Do you agree with this? Also, very carefully look at the big candle just before the close, similar to the previous example. It indicates big players are not interested in carrying their short position overnight, right? Or they have started building long position, right? You can see what happened on the next day. The price did not move big on the upside, but definitely it didn't fall, right? It went into sideways and then upside move. Now look at one more example. This is the Reliance daily chart. On 10th January 2024, the price tried to break the resistance trend line, right? Now look at the close on that particular day very carefully. It closed very close to the high of the day, right? The close is very high compared to the high. Let's get into the 50-minute time frame on the same day. See, close also happened near the day side, is very visible in 50-minute chart. But also look at the big candles that formed during the day. It clearly shows that big players are building their long position and also carrying for the next day because there were two big candles, right? It indicates the presence of big bulls. You can see what happened after that, right? This is the importance of previous day close. First punchline for the day: only entry and exit decides the fate of your trade, irrespective of your education, reputation, or experience in the market, friends. Isn't it? Now, the second important point is open interest. See, friends, many people think open interest is nothing but a volume, but that is not the case. Open interest is different and volume is completely different. Open interest is the number of contracts of a particular security which is open, which means which are traded but not yet liquidated at the end of the day. Okay, that is open interest for you. And open interest is applicable only in futures and options. Open interest concept is not available with equity. This concept is applicable only to futures and options market. Now, I don't want to dig deeper into open interest now because I've made a separate video. I will share the link in the description, but I want to keep things, as simple as possible. So if the price is going up, if the open interest is going up, then it is bullish. Okay, so don't worry, where to find the open interest information. I will share all those information later. I will also share the information in the description as well, but try to understand the concept very well. If the price is going up, if the open interest is also going up, then it is bullish. I hope this is very clear. Next, if the price is going down, the price is coming downside, but open interest is going upside, then this is bearish. Okay. If the price is going up, but open interest is coming down, it's not bullish actually. Okay, so if the price is going up, open interest is going up, then it is bullish. But if the price is going up, if the open interest is not supporting, it is not going up, means it is not bullish. Please remember this very, very carefully. And one more is, price is coming down, open interest is not going up, it is also coming down, means it is not bearish. If the price is coming down, open interest is going up, then it is bearish. But if the price is coming down, open interest is also coming down, means it is not bearish. These are the four important scenarios you should remember very, very carefully. But if you get confused with all these things, try to remember two things very, very clearly. If the price is going upside, if the open interest is also going upside, then it is bullish. This is very clear. Right? Price is going up, open interest going up, it is bullish. Second scenario is, price is coming down, open interest is going up, then it is bearish. Remember these things very, very carefully. Price is going up, open interest is going up, bullish. Price is coming down, open interest is going up, bearish. These two are very, very important. So now I have explained this open interest concept, how it is different from volume in detail, in depth, along with many open interest source in this video. So if you want to know more about open interest, you can watch this video. I will share the link of this video in the description as well. Now let's study how the open interest gives a very big clue in the next day movement. For example, Nifty, this is HCL Technology daily chart. HCL Technology displayed a big bearish engulfing as indicated in the arrow mark, right? So the next day, whether to have a bearish view or not, okay, because it is displayed a bearish engulfing, that's okay, that's one part. But supporting evidence we need, right? For that, if the open interest is also increased on the bearish engulfing candle day, the second day, then it is confirmed that there is a the big players are also carrying the short position. There is a high possibility of price going on the downside, right? So let's see the open interest chart information, because as I said earlier, the previous chart was HCL Technology spot chart, but we need to study the same in futures and options chart. So this is a HCL Technology futures chart. So let's see what happened to the open interest information on that particular day when the bearish engulfing formed. Okay, if you see this open interest, actually downside is open interest information, it is increased actually, right? From small bullish candle to big bearish candle, engulfing candle, actually the open interest increased. So price fell, open interest is increased. It is a clear cut of bearish information, right? Bears are rocking the market. So the next day also there is a high possibility of price going down. Okay, market displayed with a big gap down open and it went downside, right? So this is how open interest gives a very vital, crucial clue into the next day movement. So when we look at interestingly, actually, the HCL Tech fell even when the market went upside. Because see, if you look at this, Nifty went upside actually on that particular day, but even when the Nifty went upside, actually HCL Tech went downside. So that is how open interest powerful is. Now we will look at one more example. So this is ICICI Bank daily chart. Okay. It displayed a big breakout candle actually. It came out of a big resistance zone, right? So now let's study what happened in the previous day. There is a small red candle, right? There is a small red candle before the breakout. Let's study what happened on that particular day and the previous day with respect to the open interest. Okay. See, this is the open interest information. If you look at the small doji candle, so what happened was open interest actually reduced a little bit, right? Which means market fell, open interest also fell, which means it is not bearish. If the price comes down, if the open interest goes up, then it is bearish. But in this case, market doji, there is a doji small selling candle, but open interest also decreased, which means it is not bearish. So it is clearly saying it is not bearish. The only possibility is sideways or bullish, right? So that is the reason ICICI Bank displayed such a big move, maybe more than 4% on that particular day. We will look at one more example. This is IOC chart. See, the price displayed a decent move. I will not say it's a very big move, but a decent breakout from the previous resistance zone, right? Close to 174, 173 was the resistance zone. It break out of that resistance zone. Now, if you study open interest information one day before, another day before, it gives very important clue. See here, the open interest actually increased. Price went upside, open interest increase. It is bullish, right? If the price is increasing, open interest is also increasing, then it is bullish, right? So there is no wonder, IOC displayed a medium breakout candle on that particular day. Now, below are the free sources to get open interest. So one is, you can, if you open an account with Fire's trading terminal, you can access open interest information for free. Whatever the charts have displayed now, it is from Fire's trading terminal only. So you can open an account with Fire's to access this open interest information. I will also share the link in the description to open an account with Fire's, and this information is also available for free with Sensible. Most of you know Sensible, right? So you can also access this open interest information in Sensible. Now, the punchline, the second punchline is, you are 100% right if you are making money with any trading concept, and you're 100% wrong if you are losing money with any trading concept. You don't have to take the validation of any other traders. Opinion of other traders doesn't matter, right? We will move on. The third important concept is open action. Friends, the first 30 minutes of price action after the market open is very crucial, and it sets the tone or direction for the remaining part of the day. Now, many people, whenever I explain this, many people get confused with the bullish candle or bearish candle, or even a sideways candle. So I will give a small overview first about what are the bullish candles, what are the bearish candles, and what are the sideways candle, and then I will proceed with the explanation. See, this is very straightforward, right? This is a Marubozu candle. This is a bullish Marubozu candle. This is a bullish candlestick pattern, right? So the second pattern is, it's a kind of hammer pattern, right? So this is also a bullish. The wick, the small line, it indicates the buying strength of the wick. So this is a bullish candle pattern. So the third is, there is a small selling wick on the upside. Now, the big wick from the downside, the body overall indicates bullish. Only the small wick on the upside, it indicates selling. So on overall, it is a bullish candle. I hope this is clear, right? The fourth one is, we have a small red candle body and a big buying wick. Many beginners, even intermediate level traders, they consider it as a bearish candle. It is because by looking at the color of the body, color of the candle, they decide it is bearish. No, friends, this is not correct. Why? Because only the body is selling part, right? But if you look at the wick is more, right? So selling is only this much, whereas buying is this much. So in this candle, buyers are more powerful than the sellers. So it is a bullish candlestick pattern, not bearish, okay? So this is a bullish candle pattern. So the next one is this one. Again, it is similar to the previous one, but it has a small selling candle. Even if you consider the small selling candle and the body, the selling is only this much, right? The buying is this much. Buying is more than 2 to 3 times of the selling, right? So even this is a buying candle. I will repeat, this is a buying candle and this is not a selling candle, friends. The last one is this. So many people consider it as a doji. There is no doubt it is a doji. But you should know where is the open and where is the close. It is, if it is at the middle, it is a perfect doji. It represents indecision. Whereas in this case, open and high happened at the top. So if you ignore, time being, if you ignore open and close, the selling is only this much, whereas the buying is this much, right? This is the open level. Selling is only this much, buying is this much. So compared to the selling, buying is very powerful. It's more than 3-4 times, right? So this is also a buying candle. This is also a bullish candle. I hope these things are very clear. So let's move on. So these bearish candle patterns. Once again, this is a bearish Marubozu, classic bearish pattern. Next one is inverted hammer, or you can say pin bar. So this is also perfect selling candle. This, it is a selling wick. The body is also selling. It is a perfect complete selling candle. Next one is there is a small buying wick, but compared to the buying wick, the body and the selling wick is more. So this is also a perfect selling candle. So next one is the body is only green color, but indicates buying. The buying is very small, but the selling wick is more, right? So compared to the buying, selling is more. It is more than 3 times. So this is a bearish candle and not a bullish candle, friends. So next one is same thing. It has a small wick. Again, in this case, the buying wick is only this much. The body is red candle, it is selling, and the wick is also selling. So the overall, it is a selling thing, and buying is only this much. So selling is more powerful compared to the buying. So this is also a bearish candle. And the last one is doji. Once again, the doji open and close on the downside. So selling wick is this much, buying is only this much, right? If this is the open and close level, selling is only this much, buying is this much. So sellers are more powerful in this particular candle compared to the buyers, right? So this is also a bearish candle. I hope this is very clear. So the last few patterns are neutral patterns or sideways patterns. So in neutral patterns, if there is a doji, open and close happens exactly at the middle, means it is perfect neutral pattern. So next one is if there is a small body, whether it is green or red, if the wicks are same, then it is also a neutral pattern. Third one is also the same. In this case, there is a small green body, but the wicks are same. So this is also a neutral pattern. I hope you are very clear with these patterns. Now the point is, initial 30 minutes of the price action decides the direction for the day. That is what I'm trying to claim on most trading days. I will not say this is 100% reality, but it happens on most trading days. So this is a Reliance Industries daily chart. Now we will look at the first 30 minutes of price action, and we will see what happened on that particular day. This is a 15-minute chart. See, in first there is a big buying candle, right? Then price went sideways to small upside. So buyers are in control. First 50 minutes, it stayed upside only. The second candle, it is a small, the buying wick is the indicates a small buying wick, but the candle and the upper is selling wick. So close to 40% is selling, 60% is buying, but price went little downside. This is an exception. It is fine, not a problem. So if you go to some other day, first candle, there is a big selling wick, but the second candle, complete buying, right? So first 30 minutes indicates complete the presence of complete buyers. So the price went upside on that particular day. So now this is a selling wick, right? It's completely selling. First candle, second candle, both indicate selling. Price went downside on that particular day, right? There is no doubt about it. Next is there is a big selling wick, small buying wick and small body. So this indicates sellers. Price went downside on that particular day, right? The third one is there is a selling wick on the first candle. Second candle is a kind of doji, but selling is there. But this day it went upside. It is an exception, so it is fine. So in this day, there is a big doji, right? It indicates indecision. Even the candle is red color. There is a big buying wick. There is a big selling wick. It indicates, volatility of the market. So in this case price went downside first, then it went upside. So this is also called as kind of neutral day in market profile. It indicates volatility. So this is it's the first candle itself already indicated the volatility on that particular day, right? So in this day, it is a big bullish candle, first candle, but there is a selling wick is there, but the second candle completely negated all the buying. So the first candle buying came, second candle all the buying disappeared. So the only probability is sideways to bearish. So in this case, it went into sideways mode, right? So in this case, big buying wick, big buying candle, high probability of upside. So price went upside, right? So this is how the first 30 minutes of price action can give a vital clue about the direction of on that particular day. So we look at one more example. This is a Titan stock 15-minute chart. See here, it is a buying candle, right? It is a buying candle, big buying wick. Even though the body is smaller, it is a buying candle. Price went a little bit upside, but it stayed sideways. It is fine. So the next day it is selling, right? First candle is selling, price went downside. Next day it is selling, right? Price went downside. There is no doubt about it. First candle is buying, right? Price went upside. Slight upside. It is fine. So in this case, it is a bearish candle, right? Price went downside. So this is a buying candle, right? Price went upside and then consolidated a little bit. So this is volatility, big buying wick, big selling wick, but it's kind of indecision, but still price went slightly upside. So in this case, it is kind of selling, right? First candle is small buying wick is the small buying wick is there, but second candle completely negated the buying, right? So price went downside. So these first two candles already indicated this. So my point is, if you observe the price action of first 15 minutes or first 30 minutes, it gives a vital clue about the direction of the instrument for that particular trading day. So even if you have a, suppose let's say you have a bullish view before the market open, also observe the price action of the first 50-minute and 30-minute. If you've already taken a trade, then include this. If the first 30 minutes price action also supports to you, then you can carry your trade. But if the first 30 minutes doesn't support your trade idea, then you can exit the trade, or if your plans to take a new trade, you can avoid the trade, right? Now, so that's what I'm trying to say. Try to align your trades, along with open interest, along with the previous, everything, along with this, the first 30 minutes price action. That's very, very important. So one more punchline. You are the average of the 5 people you spend the most time with. This is a famous quote given by Jim Rohn. Jim Rohn is one of the wonderful motivational speaker and entrepreneurs in the world. So whomever you stay very close, 5 people, you becomes the average of those 5 people automatically. So always use your brain, mind, and pick those 5 people very wisely. Moving on, the fourth important parameter is trend. I don't have to give more information about trend, because in trading we have two types of trading: trend trading or trend following trading. Another one is contra trading. So when I say contra, I will explain one by one. So when I say trend trading, there is a high accuracy when you adopt or when you include trend trading, but you don't get an explosive moves every single time. You might get once in a while, but you don't get explosive moves in trend following technique most of the times. Whereas in contra trading, accuracy is very, very less, but there is a high possibility. I mean, that's what they aim actually. So contra traders aim to capture very big moves actually. So I'll explain with the chart. For example, this is a same Titan chart, daily chart. So here the trend is upside, right? So the trend is very clear, it is upside. Taking a long trade here or taking a long trade here is a trend following trade. Okay. So I know this is a daily chart, but try to understand the concept first. Then you will be able to implement the technique in intraday trading, either in 15-minute or 10-minute or 5-minute time frame. So following the direction of the trend in the higher time frame is trend following technique. Okay, so in another words, or in another type of trading is trend is upside. Okay, trend is upside, trying to take a trade opposite to the trend. In this case, trying to take a short trade is trend, I mean the contra trading, right? So trend, the direction of the trend will be upside. Taking a short trade against the direction of the trend is contra trading. Suppose if the direction is downside, taking a long trade which is against the direction of the trend is contra trading. Okay, so I've not heard many contra traders in the world. Maybe my exposure is limited, or I don't, interact more with the traders. But as far as I know, Paul Tudor Jones is the only famous contra trader in the entire world. He says, I believe the very best money is made at the market turns. Everyone says you will get killed trying to pick tops and bottoms, and you make all your money by playing in the trend in the middle. Well, for 12 years I have been missing the meat in the middle, but I have made a lot of money at tops and bottoms. When you hear this quote, it is very provoking and influencing to jump into the contra trading, right? But at the same time, in one of the interview, he says many people says that Paul Tudor Jones is capable, or he captured, or he entered a short trade at the top, at the peak. But what they miss is they miss to add one line. Paul Tudor Jones was capable or entered short trade at the top in his fifth attempt or sixth attempt. That's what he says. What it means is his accuracy will be very very less. Out of 100 trades, he will face 70 to 80% of the failures, because when he gets success in fifth or sixth attempt, he would have lost money in five trades, right? So only one trade is successful. Even if you take that, it is only 15 to 18% successful, right? So he says very very clearly that Paul Tudor Jones was capable enough to enter short trade at the top, but in his fifth or sixth attempt, he mentions that very very clearly. So my suggestion is, you should ask one question to yourself: do you have the capability, confidence, and patience to digest five failures continuously, small failures continuously, and then and within that five failures you should not lose more capital and then attempt sixth trade? No, right? Many of us, or most of us, we suffer a lot whenever we face a one failure, a two failure, a three failure, right? Immediately we get into revenge trading mode and we lose more money. Beside, we also risk more capital per trade, and we feel very bad whenever we take three or four failures, right? So Paul Tudor Jones psychology is different. Okay, he will risk only small capital. Let's say he wanted to take 1,000 lots. He will not take 1,000 lots in first trade itself. He will take only 50 lots, or he will take only 100 lots. He will test the water. If everything starts going fine, then only he will punches the order. So when we don't have that kind of mindset, it is better to stick to trend following technique, because the accuracy is good with trend following technique, right? So it is better we stick to trend following. Now again, in trend following, especially with respect to intraday trading, we have two types actually: long term and short term trend. Long term trend and short term trend. So how to identify them? It is very simple. So if you are an intraday trader, 15 minutes is the best time frame to take intraday trades. So you should always refer the one higher time frame. My suggestion is daily time frame is the best. The trend in daily time frame is the best, but little aggressive traders, they can also look at the trend in hourly time frame. But for normal or beginners to intermediate level traders, I always suggest you should stick to the trend in daily time frame. Okay, so now for example, let's say this is a Titan company, the same. The major trend is up. Price went from here to here, right? The major trend is up. Now if you look at the minor trends, see, this is a minor trend is up. Now minor trend is down. Now minor trend is up. Now minor trend is down. Minor trend is up. Minor trend is down. Minor trend is up. Minor trend is down. Minor trend is up. Minor trend is down. My suggestion is, even when you take intraday trade, try to align your intraday trade with the major trend, with the minor trend. Then there is a high possibility of success. Let's look at one more example. See, for example, the same Titan. In this case, minor trend is down actually. This is a piece, a direction, a information taken when the minor trend is downside. So the major trend is up, right? You remember major trend is up. But still, if you look at the long trade opportunity in these days, the lines separated are the days separation. Okay. So even if you look at the long trade opportunities, you wouldn't have, you know, get more number of successful long trades, right? If you would have taken a short trade, it is highly successful. So even when the minor trend is opposite, don't plan your trades. So when the major trend is up, when the minor trend is also up, then plan for long trades. If the major trend is down, if the minor trend is also down, then plan for short trades. So this automatically increases the accuracy of your trades. Now, one more punchline. All you need is one pattern to make a living. Linda Rashke. So this is one of my favorite quote in trading, friends. So many people, they start jumping from one system to another system, one system to another system every month. But my suggestion, even Linda's suggestion, is you need only one pattern. If that is enough to survive in trading. Now the fifth point is gaps. Again, in gaps, small gaps in the expected direction is acceptable, which means, let's say today, for tomorrow's market, I am bullish on a particular stock. If the price opens with a small gap, it is acceptable. But if the price opens with a big gap, it brings a risk, because gaps are always enemy for intraday traders. Why? Because if the price opens with a small gap, it doesn't matter much. It doesn't attract the sellers of the higher time frames. I will repeat once again. Listen to me very carefully. If the price opens with a big gap, it doesn't attract the sellers of the higher time frame. But if the price opens with a big gap, it attracts the eyeballs of the sellers of the higher time frame. So that's where it becomes risky. Okay. Now we will look at some example. For example, Titan company, the same. See, let's say you have a small bearish view for the next day. This gap is acceptable because this is a small gap. So this is acceptable. You can continue to take a short trade. If there is a plan for entry, you can continue with it. But if you look at here, Adani Enterprises, see, if the gap is huge, right? There is a big gap from the previous day close, which means it already attracted the buyers of the higher time frame. So anything can happen. I'm not saying it will go up only, but anything can happen based on the participation of higher level participants. Okay, this is very, very important. Now we will look at one more chart. So this is Adani Enterprises once again. See here, there is a huge gap, right? There is a big gap. Even the major trend is down, there is a big gap. But what happened next is price went upside, right? It didn't go down. If there is a big gap, in this case, it attracted the eyeballs of the long-term traders. I mean, when I say higher time frame, long traders, so they entered and their participation pushed the price on the upside, right? So that's where, small gap is acceptable, big gap is not acceptable. When I say this, many people ask, Indra, when you say small gap, whether it is 500 points, 1000 points, they ask questions like this. Friends, remember, I cannot give points like that. Why? Because every instrument is, that it trades with a different price level, right? Some XYZ stock is trading at 1000 rupees, some ABC stock is trading at 10,000 rupees. I cannot give 500 points or 1000 points is a small gap, right? So you can conclude as a thumb rule, if the gap is less than 0.5% or 0.4%, it is a small gap. If the gap is more than 0.5%, then you can consider it as a big gap. That's very simple. 0.5%, not in terms of points, okay? Remember, in terms of point percentage. 0.5%, the gap open above 0.5% from previous day closes, big gap. Any gap open less than 0.5% from the previous day close is a small gap. So if there is a small gap, continue with your trade. If there is a big gap, avoid the trade. That is the best option. Now, one more punchline: bulls make money, bears make money, pigs get slaughtered. Which means you should have a perfect clarity in trading. Whether to take a long trade or whether to take a short trade or to stay away. But when you are in confusion and when you participate into trading, you lose a lot of money, friends. Now the last option is market direction. See friends, whenever the Nifty goes upside, most of the stocks goes upside. I'm not saying all the stocks, most of the stocks goes upside. There are very few stocks which goes downside also. And when the Nifty or markets goes downside, most of the stocks also goes downside. So there will be few exceptions. Very few stocks might go upside, but the number of those stocks is very, very less or limited. So let's say on Titan stock, you have a bullish view. Next day, Nifty is bleeding, which means the major trend in Nifty is bearish, minor trend also Nifty in bearish, Nifty open action is bearish. Then even if you have a bullish view on Titan stock, I suggest to avoid long trade with Titan. Why? Because you are taking the trade against the direction of the market, right? Because most of the stocks follow market. So why to take risk? Okay, so you can always take a trade on some other day when the major trend in Nifty or index is bullish, minor trend is also bullish, your stock view is also bullish. When you align with this, there is a high possibility of getting more success. You can check this with the heat map. When you go to trading view, if you open the heat map, you can see it very clearly. For example, today I will go to heat map. This is the heat map of today. So this clearly, I will reload this. So this shows very clearly that red color, right? Bears rock the market. TCS minus 1.28%. There are many red color, right? Which means there is a high possibility of market going downside. So if you look at the charts, if you go to charts, if you look at Nifty, for example, you will get very clearly. See, okay. See here, price opened here, it went upside, but last 3-4 candles, it fell big, right? So this information you get it from heat map itself. So see, this is the heat map. You can get all this information from the heat map itself. So my suggestion is always follow the direction of the market. Don't take the trades against the direction of the market, and always try to align your trades with the direction of the market. Friends, if you include these 6 parameters in your intraday trading, there is a high possibility of getting good accuracy with your trades, and the losing trades will also come down. Even if you get some losing trades, you lose very less money, okay? Because there is a high possibility. All these parameters, if you align it properly, there is a high possibility of getting success in the market. Friends, I hope this video is highly informative and beneficial for you. If you like the content, could you please like and subscribe and share the content with your friends? I will see you in the next video with more useful content. Thank you.